ladies and gentlemen, good morning. And thank you, Simon and Walt, for bringing up the foundation of the international chemicals business, which I will kind of now describe further and maybe start with a personal note first of all. As Simon has said, I joined Sasol just a year ago, and I was amazed by this business, by the global reach, the new and the strong assets we have, and also the broad portfolio of chemical products which are used in consumer and also industrial applications. At the same time, I was surprised, though, about the financial results. The situation has been challenging for everyone, or most of the chemical players, in the recent years. Nevertheless, from the outside, it looked as if Sasol is burdened more by the recent downturn than others. So I thought there must be something to improve, to increase the profitability and also leverage the new footprint of this business. And before I share my observations of Sasol's international chemicals business situation, our improvement plans, and what we've done so far already, let me reconfirm to you that my assumption was right. There's a lot we can do ourselves to improve the profitability and the resilience of this business. With a presence spanning 12 countries, we integrate cutting-edge technologies into world-scale facilities to source, produce, and market high-quality products. Our reach extends over 4,000 customers across 88 countries and various industries, generating altogether a revenue of $4.5 billion. Despite our impressive footprint, though, we recognize that this business has not performed to its full potential. We have clear plans now to enhance significantly shareholder value by fortifying our international chemicals business. And let me set the operating context for our chemicals business first. Over the past decades, there have been a lot of petrochemical cycles. Only this one seems to manifest itself for much longer and also at a lower level than before. So the chemicals business has been navigating this challenging operating context over the last years, and one of the primary hurdles as well has been the muted demand, particularly from China and Europe. And despite the recent interest cuts in Europe and also stimulus packages in China, the chemicals industries continues to face subdued demand. And substantial geopolitical uncertainties affect additionally the trade flows. The situation is compounded by new capacity coming online at a time of structurally weaker global demand in recent years. And given the scale of that overcapacity, chemical producers will face subdued demand, lower margins, and increased competition in 2025 and the years beyond. Additionally, gas prices in Europe remain high, and also the evolving sustainability targets and regulatory policies have resulted in ambiguity in global sustainability benchmarks. Adhering to diverse and frequently changing environmental regulations often leads also to increasing operational costs. Additionally, we at Sasol have faced internally significant challenges and as a result have underperformed our peers. In fiscal year 24, our EBITDA margin stood at 6.4%, while our peers achieved on average a level of 12.5%. Together with my leadership team, we have identified several of the key challenges for this business. The first challenge we faced was that our recent investment in Lake Charles has fallen short of expectations. Secondly, several of our assets have enhanced operational reliability issues, including our legacy Lake Charles ethane cracker, which suffered a fire resulting in 8-month downtime from March to November of 2024. Thirdly, our previous organizational structure was regionally focused, leading to duplication of functions, roles, and also systems. Additionally, we were carrying stranded costs from previous asset optimizations. Altogether, this resulted in high overhead cost and inefficiencies. Now, these challenges provide opportunities, and we are turning the business around by leveraging the strengths of the business and the competitive advantages we have to drive improvements and achieve better results going forward. We are strategically positioned to benefit from our access to cost-effective ethane feedstock and also low energy cost environment in the US. Our global assets are geographically close to our key customer markets and geared to meet increasing demand. And we pride ourselves on our established and strong relationships with our customers and main brand owners in targeted markets such as fabric and home care, personal care, metalworking and lubricants, abrasives, or catalyst supports. Our product portfolio is tailored to address the needs of multiple markets, and the end markets which we will focus on are structurally sound. Throughout the business, we have experienced and knowledgeable team members, for example, our technical experts in our state-of-the-art and global R&D facilities. They work very closely with our customers to meet their current and also the future needs by collaborating on innovative solutions. On the sustainability front, we remain committed to delivering our part of the group's greenhouse gas target of 30% reduction by 2030 from our 2017 base, while at the same time we are lowering the carbon footprint of our products for our customers. So you may ask now, how do we leverage all of this into closing the profitability gap to our peers and enabling profitable growth? Over the last months, we have developed a plan stretching now over the next few years with a strong and clear focus on fostering a strong and resilient foundation. Then, post-fiscal year 28, we will build on this to leverage options for Sasol, as Simon has mentioned, and grow the business further. Our initial reset phase is centered on improving our profitability, and it consists of 3 core strategic initiatives. First, we have made conscious decision to change our go-to-market strategies by implementing a tailored and market-oriented operating model for commodities, differentiated and specialty products. The shift from a volume-driven to a value-driven approach ensures a stronger focus on margin expansion over scale. Secondly, we are reviewing our global asset footprint and to maximize value going forward. We have already taken decisive actions to mothball or close 4 of our assets across Italy, Germany, and the US. Finally, cost discipline is a key driver to improve International Chemicals' financial performance. And we have started with implementing a new organizational structure and also various excellence programs, such as our recent Procurement Excellence Initiative, which is targeting unlocking value across direct and indirect purchases. This will deliver already more than $30 million EBITDA uplift this fiscal year. Altogether, our reset phase will deliver an EBITDA uplift of $350 to $400 million by fiscal year 28. Importantly, all of this is underpinned by a renewed culture and mindset with a goal of fostering a cultural transformation that reignites the power of collaboration and the spirit of winning. At International Chemicals, we benefit from integrated value chains with a tailored approach for each of our businesses to meet the customer needs and also to deliver returns for Sasol. To start with our base chemicals business, it provides critical raw materials for captive use in our alcohols and ethoxylate value chain, based on those products which are based on disinfectants. This includes also ethylene and industrial intermediates such as ethylene oxide and monoethylene glycols, which are sold to merchant markets. The focus in this business is to become leaner, more efficient, and also maximize our cash generation. In Care Chemicals, which is a leading producer of surfactants and intermediates, fatty alcohols, and linear alkyl benzenes for 3 distinct markets. One is fabric and home care, as I mentioned before, industrial and institutional cleaning, and personal care. Certain portions of this portfolio behave like commodities, and the focus of the Care Chemicals business in these areas is to unlock value by implementing a commodity business model for these businesses. This approach will reduce cost and improve regional competitiveness in commodity detergent and surfactant applications. We have initiated this process already by reducing the capacity for LAB in Italy, as previously mentioned. On the other hand, our world-class portfolio of surfactants and alcohols enables innovations like cold water wash. And in this area, we also continue to drive disciplined innovation, targeting, for example, differentiated markets like personal care, health, and the wellness segment. Over the past few months, I have met several of our largest, also Care Chemicals customers and major brand owners, along with our commercial team. And I have been really impressed by the depth of our relationship, and most importantly, by the commitment to jointly continue developing sustainable solutions that provide value for both parties. In technical formulations, we will unlock further value through expansion and development of differentiated markets for alcohols and specialty alkoxylates in key industrial applications. This business is well positioned to deliver as well components that enable a superior performance in metalworking lubricants and other high-value industrial applications. Lastly, the advanced materials business houses our specialty alumina portfolio, which finds applications in end markets such as engineered abrasives for precision machining, or also technical ceramics for use in artificial hip and knee joints, or various catalytic applications. A key strength of our advanced materials division is its ability to provide tailored solutions to our customers and therefore emphasizing the specialty nature of this business. By focusing on tailored solutions and targeted market expansion, International Chemicals is well positioned to meet the current and also the upcoming customer needs and unlocking value for both the customer and Sasol. The closure, sale, or mothballing of an asset is never an easy decision. We fully understand the impact these measures have on our employees, and therefore, these decisions are not made lightly. However, to ensure a sustainable international chemicals business, we believe these actions are necessary. Recently, we made decisions to mothball our alkyl phenol and HF LAB plants in Europe, as well as our US Gerber plant. And further plans are now progressing as well for the closure of our phenolics producing sites in the US, Greens Bayou and Winnie. All of these decisions were driven by a combination of weak market demand with no signs of recovery, global overcapacity and/or sustained higher input costs. All of that negatively impacting our profitability, where we did not foresee this changing in the medium or long term. These actions will have a minimal impact on our integrated value chain, but it will lead to reduced cost and capital requirements going forward. We are already well on track and expect to see a 50 to 60 million US dollar EBITDA uplift per annum from these measures by fiscal year 26. The asset reviews will remain part of our normal business process while we continue to optimize our portfolio. Lastly, to further reduce our cost base, we have also identified 3 different levers. Firstly, we streamlined our organization across all functions and all regions. This started with a leaner executive management team with consolidated functions organized along our global value chain, rather than a regional model. This new organizational structure enables us to standardize our processes and systems and apply best practices globally, resulting in higher efficiencies and also making faster decisions. Secondly, we have adjusted our operating model to be a fit-for-purpose go-to-market strategy, market organization, with defined service levels for differentiated for commodities and specialty products as described before. We launched with that a commercial excellence program to define the different business needs based also on a customer segmentation. Lastly, to accelerate cost efficiencies, the focus is on operational excellence. And here, we facilitate and guide a unified approach to global operations across the entire international chemicals business. Our goal is to produce quality according to plan, while we ensure zero harm for our people, assets, and also the environment. This is achieved through the efforts of an innovative and enabled and highly skilled personnel, utilizing reliable and compliant assets while continuously improving our production cost and operational methods. Our excellence programs are supported by our new SAP S/4HANA platform, which is currently in implementation. This updated platform enhances our ability across all functions via globally aligned processes based on best-in-class standards. This is a big step forward compared to our fragmented legacy approach using regionally focused SAP systems. We will also introduce organizational structures that will increase the efficiency of the end-to-end processes. The impact of all of these actions will be significant and will be delivering between 15 to 20% reduction of our fixed costs by fiscal year 28 versus fiscal year 24. We understand the urgency of turning our business around, and we are moving at pace with decisive actions. As you've heard, we've made decisions already on assets, and the full benefit of these decisions will become evident in the next fiscal year. The unfortunate fire incident which we had in the US with our legacy ethylene cracker being off-taken for 8 months, I'm pleased to report now that the production has been stable for the last 6 months without any further safety incident. The new streamlined leadership team is working effectively together to ensure that we are on track with our turnaround strategy, and the results of our actions have already started to show, as Walt has mentioned, in the half-year results, where our half-year 25 EBITDA has almost doubled year on year. The streamlining activities are in full swing, and the recent last milestone being our go live for our new ERP system in Italy in April. And we are confident that we are on track to creating a healthy and sustainable business for Sasol. As I close, I would like to reiterate our commitment to strengthening the international chemicals business. Our targets remain bold, and we are confident in the ability to reach them through the decisive actions we have already taken and further identified. We are on track to be free cash flow positive before financing costs this fiscal year. And the significant investment we made in the US has incurred substantial debt. But we believe we will be in a much better position to service this US dollar debt with stronger US dollar cash flows going forward. This will put us then in a strong position to embark on our growth journey to build on our position as a global leader in surfactants and associated value chains. By the end of fiscal year 28, we anticipate that our international chemicals portfolio will be a $750 to $850 business, EBITDA business, achieving more than 15% EBITDA margin through the cycle. However, this will not be an overnight result. We expect this journey to spend the next 3 years to achieve this ambitious target. And as an investor, you may be wondering, given all the challenges, if this business can be turned around. Well, after a year in the role, my team and I, we are convinced that this is indeed possible. We are confident that the strategic initiatives that we have already identified will yield significant value, and we look forward to sharing more of the positive outcomes in these actions and decisions. Thank you, and please let me hand over now to my colleague Victor Bester to share more on the Southern African operations.